Hello everyone, this is SPY Trader. I trade the SPY ETF, which is the equivalent of the S&P 500. I'm going to be talking in both general terms so novices can understand, and also in terms that experienced traders can understand. And my goal here is to just educate people that have money in the market but may not know much about it. Basically, how the market trades, and to those experienced traders, things that I look for. I picked the SPY ETF, which is the exchange traded fund. I trade both its equity and its options for the simple reason is I believe it is the best trading vehicle out there that mirrors the entire market. It has great range, great volatility, great volume, and overall it's just a very good product to trade. I'm going to give you a little introduction about myself and tell you what I plan to achieve throughout these videos. So bear with me, this one may be a little long for the first one. I worked for 25 years on the floor of the New York Stock Exchange as a specialist broker, which means I made markets in various stocks. For the past 10 years, I've been trading my own money, and for the past 5, I've been trading specifically the SPY. And the reason for that is I want to know the SPY like I know the back of my hand, and I put a lot of time and effort into it. If you try to trade many stocks at the same time, you just can't put that time and effort and attention into it that you should. So that's why I trade specifically the SPY. Now, another important point. If anybody ever tells you that they know everything about the market and where it's going to go, what it's going to do, both the market or specific stocks, the best advice I can give you is to run, and run as fast as you can. The best I can do, or anybody can do, is give you the best odds and probabilities of what you see happening in the market and in a specific stock. And I put a lot of work and time and effort into the SPY to give myself the best chance and the best odds at making successful trades. There's no wishing and hoping in trading. You don't want a 1-for-1 trade. You don't even want a 2-for-1 trade. I want 3, 4, 5-to-1 trade, hopefully, based on the work I do and the market-generated information, which I achieve through both my charts and another program called the Market Profile, which we will get very much into detail down the road to help you make the best educated decision on a trade. So I'm going to start with some basics. We're going to break down the SPY chart, the S&P 500 chart, from the monthly to the weekly, the daily, and the intraday. I'm going to be using terminology. So when I do start using it, I will explain it for the first time. For people who do not know what they mean, maybe it's a good idea to write them down. So in future videos, when I just mention them by their name, you will have an idea what I am speaking about. So first off, here's the monthly chart in the SPY. And I'm going back to this level here because it's important. This is 17 months ago. And at that juncture, the market had been trading sideways, which we call balance. And two of the most important things you'll find in trading are both balance and excess. Balance is when the market is basically trading sideways for a time period, and it's awaiting more market-generated information because it doesn't know whether it wants to go up or down. Excess, and we'll show you that in a little while, is the end of one auction and the beginning of another. And that's the strongest form you can get for a good trading range. So here in this month, 17 months ago, we had what is called an outside month up. What that means is we traded below the previous month's low, but closed above the previous month's high. It's a very bullish number, very bullish factor, I should say. It would be the opposite. It would be bearish if it was an outside month down. But this happened to be an outside month up in the SPY. And after that time point, after that time frame, what we did for the next 14 months was one time frame up. Now, one time frame up means the month, in this case, we're on the monthly, that month's low never took out the previous month's low, as you can see. We might have traded inside the previous month, but we never got below the previous month's low. Incredibly bullish. Now, that's until we got to January of this year, where we traded at our all-time high. And then finally in February, we broke down, stopped one time framing up, and we took out 1, 2, 3 lows in a matter of days to come into what I now call another balance. It's a huge balance, and it's going to create numerous trading opportunities, but it is a balance nonetheless. And that balance, as of right now, is 286.58, which is the all-time high, and 252.92, which is this month's low as of now. We still have approximately 8 or 9 trading days left in February. So that's the monthly chart. We are in balance. Let's go to the weekly chart. Okay. The weekly chart I have, and this is all what I write in my homework on a daily basis. On a weekly chart, I have down to balance. Now, the important factor what happened last week is we had an inside week. Well, what is an inside week? An inside week is simply last week's range was inside the previous week's range. You could have an inside month. You could have an inside day. This just so happens to be an inside week, which is the intermediate time frame. Now, the trading rules on inside weeks is if you come out of it to the upside, so if you take out this week's high, when we start trading on Tuesday, February 20th, you should be a buyer and monitor it for continuation. If it comes out to the downside, you should be a seller or a short seller and monitor it for continuation. And monitoring it for continuation is just as important as the trade itself. Because if they come right back into the range after selling out of it, you have to be very careful and exit that position. Same on the upside. So right now the weekly is down to balance with an inside week, which could be setting up for a very interesting week coming up. Here's your daily. And the daily shows like the monthly range in a much better light. Here's your all-time high. Here's your low. This is the 50-day moving average. This is the 200-day moving average. This market is very mechanical. One of the main things in trading is you have to know who your competition is and what your competition is doing. The fact that this market traded down to the 200-day moving average and snapped right back tells me that it's a very mechanical market. We also got up to the 50-day, we battled it. The last 2 days we've battled it. That's another mechanical level. If this was real long-term money coming into the market, they wouldn't care about those levels. They'll go right through them either to the downside or the upside. So not only do I think my competition as of right now is high-frequency trading, algorithmic trading, day traders, I also believe that long-term money, even though this has been a tremendous trading range, has not entered this market. And when they do, on whichever side they do, it'll be very interesting to see what kind of ranges we get then. So it's very important to know what your competition is doing. Now, not only do you have to know your competition, well, what are they doing? Well, since Friday, when we flushed out and came back, this past week, Monday, Tuesday, Wednesday, Thursday, Friday, this entire market traded up. So right now, my competition, for the most part, over the last 5 days, is long. Now, we sold off late on Friday. See this line here? To me, that's a form of excess. Now, we'll have a better idea on Tuesday. If we open lower Tuesday, then that idea of excess would be a good reference point, because it told me that buying is exhausted, and that's when one auction ends and another begins. So we may try to test the 50-day And if we get below it, start getting back into this range. If we hold the 50-day and take this back out, well, then that excess no longer exists and will probably go for the 2 weekly highs and then this high. I'm going to give you some reference points, what I look for this coming week. So I'm going to show you the market profile also briefly, but I'm not going to really get into it. But for some of my reference points, I need to. Oh, one other chart that needs to be shown. This is the 30-minute chart on the SPY. I apologize. There are 13 time frames. Most traders trade in half-hour increments, starting at 9:30 a.m. and ending at 4 p.m. And they letter them A through M. So those time frames are very important in the intraday. Right now, my first reference point on the upside would be 273.62. And I'm going to go to the profile. This is the market profile. This is Friday's entire trading day. And again, I'm not going to go over the whole picture yet because there's a lot of information you can get from there. The reason I'm showing you is 273.62 is my first reference point, and that's because it was 9 wide. What does that mean? It means it traded 9 times at 273.62, which was closest to the fairest price to do business. 9 out of 13 time frames. Well, odds are you're going to revisit that area again at